Yep. Okay. Yeah. Let's start. Yep. Hi. Good afternoon, everyone. Thanks for taking your time today during lunch to join our credit webinar titled "Creating Certainty Within Your Portfolio Through Bonds." So, today we have with us Philip's Fixed Income Desk, as well as myself, who will be conducting this webinar. So, and always, just as a disclaimer, that this sharing session would just be for educational purposes and not to be treated as financial advice. So for advisors or clients, they are supposed to do their own due diligence before making an investment decision. So let me quickly run, sorry. So let me quickly run through briefly on what we'll be covering today. So first, we'll be starting off with the year-to-date new issuances bonds volume in Singapore. Then we're followed by the current bond yield environment and what is likely to happen moving forward. And afterwards, we'll throw in a few bond ideas to perhaps spur some interest before concluding the session with Q&A. Yeah. So I mean, without further ado, let's look at the bond volume for new issuances in Singapore. So I mean, year to date, there were around 40 corporates bond with the size greater than 100 million that were being issued in our local denominated currency. And of the 40 that was being issued, 26 of them were in the first half of this year, while the remaining 14 were in the third quarter and the beginning of this month. So I mean, this brings the total amount that was raised from these bond issuances to approximately around 13.4 billion. However, I mean, during the first half of the year, you have to realize most of these issuances were mainly issued by financial institutions rather than corporates, because due to the uncertain rate increases environments at that point of time. And this possesses like a challenge for corporates firms to issue new bonds. Whereas, I mean, for banks itself, on the other hand, most of them were showing like stellar results with record NII, net interest income, as they benefited from higher interest rates. So, I mean, this is the reason why when interest rates are high, banks will be able to make more money by taking advantage of the greater spreads between the interest that they paid to their customers and the profits that they earn by investing. Therefore, I mean, the banks in the first half of the year were confident in their earnings, which enables them to continue with the newer issuances during the earlier part of this year. So, I mean, as the rates are starting to stabilize, which I'll elaborate a little on moving afterwards, we are hoping to expect a much higher volume of new bond issuances, as I mean, issuers now will have more certainty in terms of their pricing. And I mean, like that recently, we are also able to start to see more issuances coming out from corporates as well, such as some of the new issuances like AIA, which is the 5.1% tier 2 instrument, or Escort 4.2 5-year senior bonds that was issued, I think, just earlier this month. Yeah. Okay. So moving on to what is the current interest rate bond yield environment and what to expect moving forward. So I mean, for those who have missed out on the latest FOMC meeting that happened on the 20th of September, just last week, the Federal Reserve has decided to maintain the Fed fund rate at a range of 5.25 to 5.5%. And they have, I mean, started, I mean, they stated that they did observe some signs of moderation on inflation. And they did see the current stance of the monetary policy as restrictive. And this decision of maintaining the current rate at 5.25 to 5.5% was also in line with market expectations. And I mean, in terms of the guidance, during the meeting, hawkish sentiments was shared as the majority of the participants believe that it is more likely than not that it will be appropriate to raise rates one more time in the two remaining meetings this year. So this slightly signals to us that we could expect another 25 basis point hike by the end of this year. So, I mean, if you were to shift your attention to the left of the screen, you're able to see this is also being depicted in the dot plot graph that was provided in this meeting, as 12 of the 19 committee members assessed that the central bank benchmark rate will be peaking in the range of 5.5 to 5.75%. while only around 5 members indicated that the rate to remain unchanged for the rest of this year. However, I mean, in terms of the rate cuts expectation for the subsequent years, the optimism was slightly toned down a little as the projected federal fund rate at the end of 2024 and 2025 was revised up by 50 basis points as compared to the previous SEP, or in short SEP, also known as the Summary of Economics Projection, that was released back in June this year, where I think at the end of 2024, it was projected to be at 4.6% and 3.4% in 2025, but all this was being bumped up by 0.5. So now it's at 5.1 in 2024 and 3.9 in 2025. And I mean, also, although recent inflationary data pointers such as the PCE and the CPI index that the Federal Reserve watches closely have shown signs of moderation since June last year, back when the total and core PCE was rising approximately around 7% and 5% respectively year on year. And the latest results for the total and core PCE that was released back in July rose about 3.3% and 4.2% year on year. While I mean, for the month of August, total and core CPI rose by 3.7% and 4.3% year on year respectively. So I mean, these have shown signs that inflationary pressure still remains sticky and also well above the targeted Fed targeted range of 2%. However, I mean, definitely these data pointers have already shown declining features. So I mean, what should we expect moving forward? It appears that, I mean, we should be prepared for one more potential hike while we approach the end of this year, as we are still a quarter percentage point away from the expected benchmark rate for this year. And also buckle up for rates to stay higher for a longer period of time, because do note that the possibility of further rate increases has not been taken off the table yet. And I mean, this was also mentioned in several occasions where I believe Jerome Powell and his committee team have stated countless times that have stated in countless meetings stating that they are prepared to raise rates even higher if let's say inflation were to trend even higher. Yep. So correct. So moving on. This is a slide of the Fed funds future curve. So this I mean, on the left you can see that this graph depicts what the market is pricing for future rate hikes or cuts. And I mean, although the market is in line with what the committee have projected in the second half of the year, they are still slightly optimistic for rates to hold till the end of this year. But I mean, this optimism is slightly subdued with their rate cuts expectation for next year, decreasing to roughly around 90 basis points for the following, as compared to 100 basis points before the latest meeting that was held last week. So previously they were expecting a 100 basis point cut for the year of 2024, but now they have toned it down to 90 basis points. So I mean, the golden question is, will US terminal rate trend even higher? I mean, personally, considering the fact that inflationary data pointers are starting to trend down from the previous year, I mean, it really reflects that the economy is indeed slowing down. Hence, I mean, for terminal rates to be bumped up even higher, I believe it's highly unlikely. But if inflation were to surge again, then yes, additional actions may be taken by the Federal Reserve. Yeah. So yeah, this is just a chart for our 6 months Treasury bill yield, and you might be wondering, why did the US interest rates creep higher, but our Treasury bill seems to have tapered off? Well, I would say it's not only for our 6 months Treasury bills that are experiencing this decline. Okay, let me show you the next chart. Yeah, so if you were to look at this chart, right, this is just a summary chart of the correlations within the US US Fed fund rate, as well as our government treasuries. So I mean, although there is some correlation, but it's not 100%. And if you were to look at this chart, right, our SGS bonds seems to be in tandem as well. So I mean, why is this so? I mean, I believe that this as rates starts to stabilize and potential cut seems to be approaching soon, the market is starting to price this in already, so resulting in the recent decline in our government treasuries. But will the yields continue to fall even lower? I believe that yields will for the yields for our government securities will be range bound for at least a while, unless there are additional rate hikes being imposed, which will push the yield higher or vice versa when the rate cuts happen. So, I mean, the most recent cutoff yield for our 6 months treasury bill was at 3.73%. And the auction results will, the latest 6 months treasury bill auction result will be coming out this coming Thursday. So with regards to what would be the cutoff yield for this auction, I would say it's likely to be similar to the previous one, which will be in a range of 3.7% to 3.8%, given the hawkish sentiments expressed by the during the FOMC meeting. So I believe most investors will also put in a higher competitive bid in this auction to push the yield even higher. Okay. Okay, moving on to some of the bond ideas for this seminar. So, I mean, the first bond that I'll be sharing would be SPH REIT 4.1 perpetual. So, I mean, this bond was announced back in 2020, back in 23rd August 2019. It has approximately 11 months till the next refix, and for the reset date for this bond, this perpetual bond, would be 30th August 2024, and every 5 years thereafter. So the reset rate for this Paragon rate would be at 5 years SOR plus an initial spread of 2.517%. So currently the indicative pricing for this bond right now, it's at 98.39, which is slightly below par. It gives off a yield to worst of roughly around 5.9%, yeah, for this perpetual bond. So why did we chose SPH REIT? So first of all, was due to the first half 2023, their gross revenue rose by 0.6% year-on-year, while their net property income grew by 0.1 year-on-year due to the higher atrium income as malls returns to normalcy. And for Paragon, their occupancy rate was at 97.8%, and their weighted average lease expiry, also known as WALE, was at 5.3 years. So, I mean, all this indicates that Paragon has a good demand for its properties. However, in particular, one of their property, which is the Rail Mall, has roughly around 54% of their net leasable area expiring in FY25. So this should be something that investors should look that they should keep an eye on. However, I mean, we spoke to the management. Not say we spoke to their management. Their management has indicated that although there's a 54% of their NLA expiring in 2025 for the Rail Mall, but the area that the property that contributes to their portfolio for the Rail Mall, it's not that significant that it will really affect their revenue stream. Yeah. So for Paragon, 85% of their debts are fixed, with an average cost of debt at 4.05. Although, I mean, 4.05 may seem high, because their management has mentioned that this was due to the higher interest rate environment. However, I mean, 4.05, it's in line with its peers within the same industry. And we have posed a question to the management asking if they are looking for opportunities to lower down their cost of debt. However, I mean, their management have replied saying that because 85% of their debts are fixed already, so they only have a 15% variable for them to to play around. So, I mean, in terms of lowering this cost of debt, I wouldn't say it's they can lower down by a lot, but yes, it was still somewhat around 4%-ish if they are able to try to lower it down. Yeah. So for Paragon, there are no further refinancing due for the remaining of FY23. And for this perpetual issuance, it's at 300 million, and it will be callable in next year at FY24. So I mean, because like I've said, there's around approximately 11 months to the next refix lah. However, I mean, Paragon has a prudent gearing of 29.8% and an interest coverage ratio of 4.4 times. So I mean, this gives off quite a possibility of a recall for this perpetual notes lah, for the next year. Therefore, we believe that a 5.9% yield right now and a potential callback for the next year for these notes, it's an ideal, it's a bond idea for investors to take note on. Yep. So moving on, which is sorry, let me shift this. Yep. So moving on would be DBS Holdings, which is their 5.479% senior that will be maturing in 12th of September 2025. However, do note that this is a USD bond. So I mean, this bond was announced back in 5th September 2023, which is earlier this month. So this is a senior unsecured bond. So it comes with a maturity date, and it has approximately 2 years to maturity. So the indicative pricing for this bond is slightly above par right now at 101.224. So it gives off a yield of slightly around 5. Sorry, I think there's a typo down there on the yield. Yeah, but the indicative of pricing for this yield is slightly around 101.24. Sorry, pardon me for the mistake for the yield. Yep. However, for this bond, there's a rating of AA from AA minus for Fitch and AA2 for Moody's. So why DBS? Why we chosen DBS? This DBS 5.479%. So first of all, because due to the rising interest rate environment, I believe that most financial institutions have benefited from this rising interest rate situation. Hence, their NII is shown that they have benefited from this rising interest rate. So for DBS Holdings, their NII or net interest income has rose by 61% year on year to 6.97 billion, as net interest margin improved by 100 basis points to 2.75%. So like I've mentioned earlier, this was due to the rising interest rate environment lah. So in terms of their CASA ratio or current account savings account, their ratio has declined slightly by 16.1% year on year, as I mean, their customers have shifted towards fixed deposit, also known as time deposit. However, I mean, despite their CASA ratio falling and resulted in a total deposit dipping around 2% year on year, it remains stable at 520 billion as compared to a year ago, where their first half of 2022 was roughly around 527 billion. So I mean, in terms of their CASA ratio, they have remained stable. So for DBS, like I mentioned, they have a credit rating of which is an investment grade credit rating of AA, and their asset quality remains resilient, with their NPL ratio remains unchanged from the previous quarter of 1.1%. As I mean, new non-performing assets formation remain low and was offset by the replacements and write-off from the previous year. And for their liquidity, for DBS, their liquidity remains above regulatory requirement of 100%, with their LCR or at 146% and their NSFR, net stable funding ratio, at 116%. And DBS also has a CET1 ratio of 14.1%. So I mean, for us, we chose DBS is because right now, because we are expecting rates to trend down starting from next year onwards. Although yes, correct, rates will be higher for longer, but because rates are expected to trend down starting from next year, we believe that right now, if you're able to lock in this 5.479% yield bond for roughly around a 2 years duration, yeah, it's actually relatively quite attractive for an investment grade bond. Yep. And lastly would be HSBC Holding, 5.3%. This is a tier 2 bond instrument, and it has a non-call of 5.5 years. So this bond also has a maturity date of 10.5 years, and it will mature on the 26th of March 2034. And this is SGD denominated. So this bond was being issued just 2 weeks ago on the 12th of September 2023. Yep. So like I mentioned, this is a tier 2 bond. So do note that these bonds carry a write-down feature similar to AT1 bonds as well. However, in terms of their risk for a tier 2 bond as compared to a tier 1 bond, as compared to an AT1 bond, it's the repayment hierarchy. So tier 2 bonds are ranked one rank above AT1 bonds. So in terms of, let's say, if a financial institution, if a bank were to face a liquidity crunch and they were to liquidate all their assets, tier 2 bondholders will get back what's remaining first before AT1s, then the equity holders. Yep, this is the tiering system. So for this bond, it has approximately 10.6 years to maturity. Yes, correct. It's quite a long maturity date. However, there's a reset date for this tier 2 bond. Its reset date will be on the 26th of March 2029. So approximately around 6 more years time. Yeah. So the reset rate for this bond, it's at 5-year SORA plus an initial margin of 2%. And the indicative pricing for this bond is slightly above par right now at 100.95, which gives off a yield of slightly around 5.1%, which is still slightly attractive at the moment. So for this bond, it carries a credit rating of triple B by S&P, A- from Fitch, and a Baa1 from Moody's. So all this grade indicates that this is an investment grade bond as well. So similarly to DBS, HSBC has also benefited from rising interest rates. Their first half 23 net interest income has grew by 38% year-on-year to 99.3 billion. So this was also due to the rising interest rate environment, and their NII rose by 39% due to strong insurance performance back in Hong Kong. Yeah. So for the expected credit loss for HSBC, it is expected to creep up to 35 basis points in the first half. No, sorry. Expected credit loss has crept up to 35 basis points in the first half of year FY23, mainly due to the commercial real estate exposure in China. However, HSBC, their expected credit loss is still within the guidance of HSBC expectation of 40 basis points. And HSBC have also stated that they have reduced their commercial real estate exposure down to 2.5 billion versus their 4Q 2022, reflecting that HSBC has been ongoing de-risking their exposure in their China real estate. So for HSBC, they have a credit rating of single A from all rating agencies. And also HSBC carries a CET1 ratio of 14.7%, which is unchanged from their first quarter, if I'm not mistaken. Yeah. So their CET1 ratio, it's above their 10.7% range, and it's within their targeted range of 14% to 14.5%. So for HSBC, the interest coverage ratio, it's also at 132%, which is above their regulatory requirement of 100%. So like I mentioned, I think we recommended HSBC 5.3% is because due to the attractive yield that is able to yield at roughly around 5.1%. Yeah. Yes, so right now, this is just a chart on the bonds run that we are having right now. So this is just a rough indication of those bonds that are trading above, they are within the range of 4% to 5% range. And as you can see, right now, I would say it's hard to find bonds that are trading above 5% and consider. Okay, it's hard to find investment grade bonds and those bigger name bonds that are trading around 5% range and above. because I mean, right now people are already pricing in that rate cuts to be happening next year. Hence, you can start to see bond yield starts to decline. Although it's true, you may say that, hey, the recent Fed speech has said that rates are to be for higher and a longer period of time, and there might be a possibility of a 0.25, a possibility of 25 basis point hike in the end of this year. So why are yields still trending down slightly? So I mean, like I said, people are already starting to price in that the possibility of rate cuts to be happening next year are to be expected lah. Hence, they are already pricing this in, and yeah, that's why the yields are slightly coming down for these bonds. Yep. Okay. So yeah, to conclude, I mean, for us, our strategy still remains to accumulate bonds that currently are as of investment grade, and also because the Fed expectation for rates to trend down starting next year, to reach a point of 2.5% after the year of 2026. I mean, this will present opportunities for investors to capture bonds which are currently trading at a higher yield level, which I mentioned earlier just now. Because if you were to compare the bonds that are being issued this year as compared to bonds that are being issued back in COVID periods, a bond that is similar in terms of risk level as well as the tenor, their coupon rates differ, I would say, quite relative if you have to look at it. So because due to the rising interest rate environment, that's why new issuances have to has to issue at a higher coupon rate. So I mean, this presents opportunities for investors to capture these high yielding bonds right now before the rate starts to taper off at a later period of time. So I mean, secondly, why do we choose banks? So I mean, because I mean, financial institution is currently positioned to sustain during the rising interest rate environment, and they are also able to benefit from it. So that's why right now financial institutions are still able to issue new bonds at 5% range. However, I mean, one thing to note is that financial institution, although their yields that they issue seems to be attractive, however, the risks that these bonds carry do also plays a part because higher yields tends to have higher risk. And like I mentioned earlier, tier 2 bonds, in terms of risk, they do carry the similar write-down features as AT1s. Yep. So these you have to bear in mind for the use, for the risk that you're taking. So lastly, we are still in the preference of investment grade bonds that has good financial records and within the duration of 2 to 5 years. Because right now, I mean, the yield curve is inverse still. So I mean, shorter dated bonds are giving off a higher yield as compared to longer dated bonds. So I mean, that's why a lot of people are flooding into T-bills as well as shorter dated bonds in particular. However, I mean, subsequently, this will start to normalize when rates starts to taper off. And I believe that right now, because I've mentioned that T-bills right now are trading, the cutoff yield for the latest T-bill was at 3.73. So if let's say you were to look at any bonds that are particularly interested in, the bare minimum that you should go for is around 3.73. So I mean, if you're looking into a super safe instrument that is short term and almost risk-free, I would say, yeah, T-bills still seems fairly attractive. Yeah. And if I'm not mistaken, I think US Treasury bill, US currently, I think, US currently 2 years Treasury bonds are trading around at 5.2%, if I'm not mistaken. And after the FOMC meeting, I believe the US Treasury yield has spiked up, the 2 years have spiked up slightly by 9 basis points from, I think, 5.11% before the FOMC meeting, and it rose to 5.19% after the FOMC meeting. And this was the highest since back in 2006, where the Treasury yield for these 2 years was around 5.18%. So I mean, for people who are interested in shorter dated bonds, yeah, 2 years US Treasuries, if they don't mind holding exposure to US currencies, yes, 2 years Treasury are offering quite an attractive yield right now. And for their US 10-year notes, after the meeting, it has also hit a high at 4.49%. And this was the highest since November back in 2007. Yep. So yeah, to conclude, I believe that right now, if investors were to look at fixed income, yes, they can look at perhaps like bond IPOs, like bonds new issuance. So if they were to manage to subscribe to a new issuance, then this presents a potential capital appreciation, because once rate starts to taper down in future, the bonds that are giving you that are currently giving you a higher yield will tend to appreciate. Yep. Yep, with that, I would like to conclude my seminar. Perhaps I can move to the Q&A. Yeah, so for the first question, where to find all these bonds listing and info, and can retail buys? Yep. For these bonds that I've shown earlier, yeah, let me show you. Yeah, so for this all these bonds, right? Right now, you can head down to our Poem's bond page. The bonds offer page. You are able to see then there is this trade button right there, the orange color trade button. You can click on it. However, you must have a bonds Poem account. So when you click on it, they will bring you to our Poem's web page, whereby you're able to place an order right there. Yep, hope that answers your question. Do you have a DBS SGD bond that is maturing in March 2023? Right now, offhand, I can't really recall which are the SGD DBS bonds that will be maturing on March next year. Sorry, do you have a DBS maturing March 2023? Okay, so sorry, Georgie, but I don't really quite understand your question. Maturing in March 2023. Okay, for this bond right now, I can't really recall offhand if there's a DBS bond that's maturing in back in March 2023. But perhaps once I've taken a look already, then I can. Okay, I'll note down your question and put it into our community page, which is our P3 community. Yeah. So you guys can download our P3 community. So as you can see on this screen, we have a bonds community page. So for those questions that I've not answered, perhaps I'll pose your question. Then once I've identified the bonds that you have mentioned, then I'll reply there. Yeah. Okay. So next question. When bond defaults, it is hard to recover from losses. For example, many Asian bonds fund drop a lot due to the Chinese property bond default. Please comment. Yes. So when a bond defaults, right? Basically, I mean, you should be prepared to have a complete. I know it's hard to swallow, but I mean, you should be prepared to completely write off that particular bond that you're holding if the issuer has defaulted on that bond. However, if there is any like, let's say, remaining payments from the issuer, then it's a bonus. But yes, I believe just one example would be the Chinese recent China what was the Country Garden, Country Garden that was mentioned in news earlier, I think just earlier this month, where the news came out saying that there's a very likelihood, because I think for Country Garden they missed their coupon payment, but however they are still within their payment window. So when the news first came out on the default, okay, not say default, on the missed payment of the coupons, I mean, you have sent a reaction throughout the bond market for Country Garden. Hence, you can start to see like the prices for all these bonds starts to fall. However, I mean, if I'm not mistaken, I believe that the news have came out saying that Country Garden has managed to pay those interest payment at the very last day. So yes, this at a point of time where the missed payment, bondholders should be prepared to completely write off their bonds. But yes, in the case of Country Garden, they managed to pay back the interest, pay coupon payments at the very last day. Then that will be additional points for the bondholders that they managed to get back anything. Yeah. Okay, next. Sorry, let me take some question from Q&A. As you have shared, rates will trend down next year. Would it not be better to focus on rates where it give better yield than what you shared so far? So, I mean, in terms of this question, yes, correct. Focus on REITs. However, I mean, I believe that REITs also do face their own challenges as well, because due to rising rates, right? REITs are also facing quite a challenge right now, because the main objective is to borrow money to purchase more properties for their portfolio. So I mean right now, as you can see, you also don't really hear much acquisition news, acquisition on the news due to the higher borrowing costs as well. So I mean, definitely, but which one would it be better? Personally, I would say that if we are more risk averse, then yes, bonds would be the one, because in terms of rates, there is, if I'm not mistaken, I think there is a spread of roughly around 300 basis points as compared to a treasury, as compared to a fixed income bonds that you should try to attain. However, I mean, in terms of bonds itself, because yeah, there's a so-called like a guaranteed payment for every semi-annual. And if it's a bond that comes with a maturity, then yes, you are technically guaranteed to receive a principal. So there's this so-called like how to say capital preservation right there. So I mean, in terms of the yield wise as comparison, yes, perhaps yields for bonds might not be as attractive as REITs. However, I mean, in terms of risk level wise, this is why REITs are a bit slightly to be able to outperform because you are taking a higher risk. Yeah, I hope that answers your question. Okay. Sorry, not easy to accumulate in practice, but because each bond costs 250K. Instead, are there any bonds or fixed income funds that you can suggest? Yes, correct. So I mean, for bonds itself, yes, correct. It's quite hard to digest because each bond itself, it's 250K. So I mean, if let's say you were to, yeah, if you don't have that much purchasing power or what, but you still want to get exposure to bonds, then yes, you can look into bonds ETF or bonds, yeah, bonds funds lah. But right now, if I'm not mistaken, okay, in terms of the funds right now, there's one fund which is, yeah, how about let me note down this question as well, then I can jot it down inside the, yeah, sorry, let me jot down this question that I'll note. I can list down the funds that I suggest in the community page. Yeah. Okay. Sorry. Why a duration of 2 to 5 years and not longer? So I mean, in terms of why 2 to 5 years? Okay, so right now, right, our 5 years SORA is currently, okay, if I'm not mistaken, our 5 years SORA right now, the rate is at 3.45. Oh, hold on, let me double check. Yes, it's around 3.45 for our 5 years SORA rate. So if you to recall, right, let me show you this. Yes. Yep. So as you can see, right, for this SPH REIT, right, there is a reset date, which is next year, and there's a 5 year SAW and SORA lah. Because SAW right now has already ceased, right now everyone is using SORA. So for the reset rate, right now it's pegged to 5 years SORA plus an initial spread. So why 2 to 5 years? Because we want to reduce the uncertainty. Anything more than 5 years onwards will be very interest rate sensitive. So for example, if let's say right now the 5 years SOR may be at 3.45. However, next year, when rates starts to taper down, you can start to see your 5 years SOR starts to trend down even lower. Perhaps, let's say 3.4, 3.2, perhaps. Then if let's say this perpetual were to be continue and reset at a rate of 5 years SOR, if the 5 years SOR is at 3.2, then you will in turn get a slightly lower coupon. So what we want to mitigate is to mitigate the uncertainty. We want to get the certainty of to somewhat lock in the rates that we are looking for. So I mean, for me personally, I would say 2 to 5 years is a good gauge. Yeah. So yeah, so at least, right, if let's say next year, if this SPH rate were to be rolled over and to be resetted at a 5 year SORA plus an initial spread, and if let's say 5 year SORA is at 3.2, then the reset rate for this perpetual will be 3.2 plus 2.5. So you'll roughly get around 5.7 when interest rates are still high. But if let's say one day, when interest rate starts to fall off by a lot, yeah, and yield starts to come tumbling down, and if 5 years SOR goes back to, let's say, I don't know, 1% or lesser than that, the reset rate that you're getting is roughly around 3.5%, which is slightly lower than your current coupon rate of 4.1%. Yeah, that's the reason why we chose a duration of 2 to 5 years rather than a 10-year one. And although you might start to rebut saying that, hey, the last one I thought you stated was a HSBC Holdings, which is a 10.5 years maturity date bond. But what we are focusing on, it's on the investment. First of all, is investment grade, and second of all, I'm looking at the reset date, which is in roughly around six more years time in 2029. Yeah, that answers your question. Okay. With an inverted yield curve, does it mean that bonds gradually lose money? Okay, no. So for inverted yield curve, right? It means, okay, so in a normal situation where, let's say, right, we are right now not in a rising interest rate environment, what you can see is the yield curve should be upward sloping. However, right now it's downward sloping due to the rising interest rate environment. So because it should be upward sloping because, right, for shorter date duration bonds, it should give a coupon rate lower than a bond that has a longer maturity date. So for example, a 1-year bond should roughly give around 0.5%, for example, versus a 5 years bond that should give off roughly around 2% or 3%, for example. This is because for a 5-year bond, right, you're holding onto the instrument, you are taking the risk of a 5-year duration. Hence, you are being rewarded with a higher coupon rate. However, right now, due to a rising interest rate environment, right, because everything is uncertain, so everybody wants to lock in a longer rate. That's why this drove down yield. That's why we are facing an inverted yield. So previously was, okay, on a normal day, it should be upward sloping. Right now, it's the downward sloping, whereby the shorter duration bonds are giving a higher yield coupon as compared to a longer yield. So right now, you can start to see why T-bills are giving like 3.73%. Whereas if you look at normal corporate bonds of, let's say, 2 years, 3 years, are giving around 3.7, which is almost in par, but the duration is longer. So this doesn't make sense, which is why we are in an inverted yield curve situation right now. So it doesn't mean that your bonds gradually lose money towards maturity. Yep. But as bonds with maturity date, when they starts to reach maturity, then you start to see the price movements of all these bonds starts to moderate and hit back to par once it's nearing maturity. Yeah. Okay. Is there any long-dated IG bonds, including corporate maturing about 10 years, that is good in value that you can recommend? Okay, so in terms of long-dated investment grade bonds, yeah, I mean one of it would be HSBC that I mentioned earlier, 10.5 years. Another one that I can think of right now, okay, so perhaps I'll note down this question, then I'll try to find more on the 10-year one, then I'll put down on a community page. Yeah. Okay. Can we buy 2 years US Treasury bills through POEMs? Yep. Right now, our POEMs do offer Treasury US Treasury yields as well as our SGD government T-bills as well, or SGS bonds. However, do note that for Singapore Treasury bills, T-bills in short, we are able to apply on the primary market, and we charged a fee of 0.1. Yep, and there's no custody fee for Singapore Treasury bills. However, for US Treasury, we are not able to apply on the primary market, so everything would be similar to corporate bonds lah. So we'll be buying and selling on the secondary market. However, the minimum size for all these US Treasury bills is at $200,000. Yep, and there's a custody fee of 0.5 lah. Yep. Okay, hope that answers the question. Do you have do you have any SGD bond suggestion? No ratings, but strong parentage or systematically important to Singapore, not perpetual, but 5 to 7 years duration to lock in the yields. Right now, this is very respective to yourself, because you must know what kind of use that you are looking for. Because right now, I believe that there is even for very strong parentage, let's say systematically important to Singapore, there are a few but those are ranging in the years of like 30 years, or that are issued by HDB or PUBs and stuff. So I mean, I can try to find as well, but I can get back to this question in the community page. Yep. Okay. What are the charges for buying bonds via secondary market through POEMs? Yeah, so the charges right now, we are basically charging 0.25 for bond transactions. However, I mean, for the pricing that you are able to see on POEMs itself, those are already included within the charges are already included in the pricing already that they are looking at in POEMs. Yep. Will there be a course to teach on how to sell bonds in the open market? I'm new to this. I don't really know how to read the price. Example, I buy 250K SPH REIT. Instead of waiting till August 2024, I suddenly need money and want to sell Q2 of 2024 without incurring the loss. How do I read? Okay, so... Okay, yeah, sorry. Yeah, so as you can see, right, how you first off you read, right, it's so SPH REIT is the company's name, 4.1% is the coupon, and the behind, right, if there's a maturity date, let's say there's a date, for example, 23rd August, if let's say if it's a 4.1%, 23rd August, then this is a bond with maturity. However, if it's a perpetual bond, then it doesn't have a maturity. And how do you read it? For perpetual bonds, it usually comes with a reset date and a reset rate. So for a reset date and reset rate, right, is to entice, is to encourage that for the issuers to redeem these bonds and pay back the principal back to the bondholders itself. Because if, let's say, for example, in a rising interest rate environment, if let's say they were not to be, if they did not recall these bonds, and if interest rate were to trend higher, for example, if let's say saw trend. Currently, it's at 3.45. If let's say next year interest rate, there's a spike in inflation numbers. Federal Reserve decides to pump up their rates even higher, then you can start to see 5-year SORA starts to go up even further. Then perhaps it can be even further to 4%. I'm not sure. It's just an example. So if the issuer did not if the issuer did not redeem these bonds, right, then these bonds the coupon rate will be reset at, for example, 4% plus an initial spread of 2.5%, which is higher than the initial coupon rate of 4.1%. And the issuer will have to bear this higher borrowing costs. So I mean, that's why there's a reset rate and a reset date to entice the issuer to redeem these bonds. If not, they might be paying up a higher borrowing cost as they previously wanted it to be. Yeah, so this is the first thing on how you should look at bonds for perpetual. Then secondly, it's the indicative pricing. So like I mentioned, for this bond, right, the indicative pricing is 98.39. So for every new bond issuance, it's issued at 100%. It's issued at 100. So that's at par. So anything below 100 is known as below par. So, okay, the prices for this bond, if let's say the bond has a maturity date, like I mentioned earlier, when bonds are nearing its maturity, you can start to see the prices of these bonds creeping back up to the par value, which is at 100. Because at the end of the day, for those bonds that's maturity, you will get back your principal sum, which is 250K that you have invested in previously. So anything between the price will fluctuate, be it below par, which is currently this perpetual is experiencing at 98, or above par, like I mentioned, the DBS one, which is I think 101. So I mean, okay, okay, if you suddenly need money, right, then yes, you have no choice, although you are guaranteed your capital. However, I mean, if it's below par, then, for example, if let's say previously you managed to buy in this perpetual at 250K. However, if right now your perpetual bond is trading at 98 and right now you're really in need of money, then you have no choice but to sell it at the secondary market at 98, which you will face a capital loss. Then perhaps when you receive back your principal, you won't get back the full $250,000. Then you'll get back perhaps 240 something. So I mean, because all these are still market instruments, so it's still affected by the price movements, everyday price movements. However, do note that these are all indicative pricing because bonds are traded over the counter and not on the exchange itself, whereby price are being reflected instantly. Whereas this one, where we have to speak to different counterparties to note the indicative price, perhaps like let's say you want to sell it at 98, then perhaps we need to find another buyer that is willing to buy it at 98. And only if both matches, then we are able to do the transaction. Yeah. So I hope that clears slightly on how you're able to read the numbers for bonds. Yeah. Okay. Perhaps I take on a few more questions. Understand that US market is facing headwinds and some may wind up. If that is the case, do you think the risk for the corp bonds is getting risky given such low returns? Given current situation, by buying bonds, will the cash flow be locked up and thus lose opportunities to react to the market? So yes, first of all, you have to note that for bond investors, right, because they would not want uncertainty. So usually for bond holders, they would, when they go into a bond, right, they'll tend to lock in the yield that they are comfortable with for a period of time. So before you go into any bonds, right, like I've mentioned earlier, even for those two bonds, for those three bonds, like I mentioned, like DBS, 4.79%, you must be comfortable to lock in this rate for perhaps 2 more years before you move into this bond. Because first of all, if you go into bonds, you want the certainty of coupon rate. Second of all is the pricing of the bond. So like you mentioned, do you think the risk for the corporate bond is getting risky given such low returns? Yeah, I would say, okay, it really depends, because that's why our recommendation is for investment grade bonds that is triple B and above, and a yield and a duration of 2 to 5 years lah. So at least yeah, okay, at least, right, there's external how to say, there's external, I would say, yeah, there's external ratings that are given from rating agencies out there that thinks that their financials are sound. So for that ones, for on the end, you are able to see there's more how to say, there's there's more certainty lah, in a sense, because there's another party vetting through the financials for you already. That's why they are able to give off that particular particular grade for that company itself. So yes, correct. I mean, in terms of this question, although I may not be answering the question, but yes, right now I'll think that for these two bonds, they are investment grade and perhaps a 2 years, or maybe a 6 years. I believe it is at a rather attractive rate lah, at 5.4% that you are locking into. Because although you might say like, hey, now shorter year dated bonds like, are giving a higher yield as compared to a longer dated one. And yes, correct. But however, but once rate starts to trend down, then all these short-term yields won't be able to sustain the yield as compared to you locking in on this 5.4% for the next, I don't know, 5 or 6 years time down the road. So yes, these are things that you have to take note on lah. Yeah, I hope that answers your question. Sorry if I didn't really answer the question, but yeah. Okay. Thank you. Okay. Let me see. Okay. Let me see the chat. May I know what is the community page? Yeah, so our community page is on our P3, which is our Poems Tree app. You're able to see on your App Store or your Google Play Store. Hold on. Sorry if I don't have the screenshot right now. Hold on. Okay, so for those users, right, that has a Poems account right now, I'm not sure if you know that right now we do have a Poems Tree application on the application store itself. So if you were to download our Poems Tree application, which is okay, which is on the phone lah. You can see it says Poems Mobile Tree. Yeah. So if you have a Poems account, you're able to log into your account on this P3 app. And within the P3 app, right? Yeah. As you can see from this screenshot, right? There is this community tab at the bottom. And if you were to click on it, you can see there's a Phillip Bond community. Yeah. So that's the place whereby I'll put on those questions that yeah, those investment ideas lah, that you guys may be looking for, or perhaps those questions that I have not answered yet. Then in the meantime, if let's say once in a while, if you have any questions that are still unsure of regarding fixed income itself, then yeah, you can drop it down in our community page, and we are able to answer there from there as well. Yep. Okay. 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 Any views from Olam bonds? Okay, so for with regards to Olam bonds, right? Yes, correct. I believe that back 2 weeks ago, yeah, there was this saga on this issue lah, on Olam itself, saying that they might face some problem because of some what's that called? Sorry, I can't recall. Sorry. They might face some issues lah. So yeah, So in terms of that, the pricing for Olam bonds has decreased slightly. I believe it's roughly around 40 basis point, if I'm not mistaken, for their pricing itself. However, all these are still unsure because, I mean, in terms of the media itself, they have not disclosed anything. However, for Olam itself, they have said that they have do their own investigation right now. However, if let's say if really Olam were to face, if the saga were to be true, then yes, this might be a problem for Olam lah, because Olam might face fines or perhaps a suspension of business. And yes, this might give this might be detrimental for the bondholders for Olam itself. However, I mean, if all these were just let's say market noises, or let's say it's just untrue news or sorts, then you can start to see Olam bond prices start to normalize again. So right now, everything is still question mark. There's no concrete evidence on what's happening in Olam right now. However, I believe back in 2012, similar case was also being experienced by Olam back when there was an article written by Muddy Waters saying that Olam was also that there is this sorry, this is the last question, but yeah, but Olam were also facing similar issues as well. So yeah, but at the point of time, that was dictated that the news was untrue, and yeah, that the price has went back up lah, to being normalcy again. Yeah, so sorry if I'm unable to answer. I hope that answers your question for Olam bonds, because right now really there's no concrete news on the progress for Olam bonds as well, for Olam side and Olam bonds. Yeah, sorry, that's all the time I have for today. So I mean, for those unanswered question, I'll put it inside the community page and try to revert back to you guys. Okay, maybe last question from Aaron. For Poems Mobile Tree, are we able to use it to trade equities as well? Yes, yeah, able. So essentially, because right now for Poems, usually when we trade bonds or equities, it's on Poems web itself. However, right now, all this function, perhaps not for the bond function yet, but we are implementing at the end of this, supposedly end of this month or the earlier next month, for the bond function to be transported into mobile tree. So for equity function, yes, you are able to trade in the mobile Poems mobile tree. Yeah. So thanks everyone. So sorry if I'm unable to answer all the questions because there's just too much of it. But yep. Thanks again for taking your time for this afternoon to listen in for this seminar. Thank you.